everyone, it is Evan here from the Trade Risk on Friday, April 7th, 2023. Good Friday. Markets are closed. Hopefully everybody's having a good day away from screens and getting a nice long weekend. We are going to continue with the show here and bring you the most important trends, price action, and noteworthy moves that you may have missed this week, a short week across financial markets. And we're going to jump right into it here with some of our top takeaways, some of what we're going to talk about in today's show. So really, this week, we finally got markets, equity markets, to slow down and digest some of the recent run-up that they've had. It's basically been three and a half, 4 weeks up straight in a row, and some indices, some stocks a little more straight up than others. It's been a mixed market, but generally speaking, equity markets have been pushing higher, and we finally got a little bit of volatility, a little bit of pullback and digestion this week. Equal weight indices are showing a notable lag here. This has been a sort of a brewing divergence, but it's starting to get clearer and clearer. We're going to look at that in just a little bit. Not really a surprise here, as we've been looking at market breadth, and we've been basically, saying it's been uninspiring to frame it sort of optimistically, but we're going to look at that in part two. We got interest rates, which are trading down to 7-month lows, and quite honestly, this is probably all you really need to know to understand maybe why the equity markets have been doing so well. We continue to see the bond market rallying. We see interest rates coming down and stocks, generally speaking, like that. We did get a new weekly closing low for the KRE. That's the regional bank ETF. So clearly, there's still some rotation or concern or just disinterest away from those regional banks for good reason, of course, but notable there. And we've got crude oil at 4-month highs. So let's get into the numbers here. Right-hand column. Again, this is a shorthand week, so your volumes are going to be low this week. But if we look at the numbers here on the right-hand side, you can see a broad-based red close here for U.S. markets. We saw the Russell 2000 continue to underperform in this market. Again, look at the 1-month numbers now, this middle column here, and look at the stark difference between the Russell 2000 down 1% over the past month and the Nasdaq 100 up 10.5%. That's a huge spread there, and that continues to essentially widen after this week. You could see international stocks. So outside the United States, things were pretty good. A little bit of outperformance there, and over the past month, it's been a pretty good place to be as well outside of the United States. Now, here's a big story here, and this is something that we talked about. Let's see, not last week, because last week we did a shorthand version, but the week before, we started to notice the change of these longer term trends here. And again, it was subtle. It is still a bit subtle, but it is noticeable, and it is, kind of cementing itself here in some of these longer term trends. And we're keeping things very simple here. We're not being super fancy. We're just saying, what's the 200 SMA doing? What's the 50 SMA doing? What's the 10 SMA doing across these, various time spans? And now we can see that the long-term trend across all of the major indices is rising here. So folks, yes, we do now have a rising 200 period simple moving average across all US major averages. It's not a steep slope, but it is a rising long-term sort of gauge here, and it is the first time now we're basically seeing this in over a year. So that is noticeable. Medium term 50 SMA, still a split race here, but basically starting to rise. The short term moving average starting to rise here as well. So the market environment steadily, one foot in front of the other, is beginning to improve, or continuing to improve depending on how you're looking at it. Vol environment, so basically not a big change this week. We did see the VIX, so the S&P 500 volatility index, creep a little bit lower this week, down back into a teenager. It's back below 20. That is a good spot for it. I mean, I do like it more under 20, just broadly speaking from a psychological perspective and kind of a regime perspective. But we're at about 18 spot 4. Nasdaq vol still in the mid 20s. Same thing with the Russell vol, still in the mid 20s. So a bit elevated. They both did a slight uptick this week, but nothing too dramatic. Now, talking about breadth, as we mentioned at the top of the show here, you can see that this week we basically had an even race on the number of stocks hitting 52-week highs versus those hitting lows in the NYSE. We had 167 aggregate new highs this week. Again, short week, nothing happening on Friday. We had 140 new lows. So really, it's kind of just this dance in the middle here. There's not a strong current one way or the other. And we're going to talk about that a little bit more in part 2. Now, if we get to sort of more of the psychological, the sentiment, and the fear index here, looking at the put-call ratio from IBD. So shout out to IBD, Investors Business Daily. They're a sponsor of our show and content. So thanks for making this possible. You can support the show, support IBD, by using this link here, get you access to their digital subscription. In the digital subscription, they do update this put-call ratio. It's not specific to them. This you can find in other places as well, but they do make it nice and orderly. And you can see we basically went out here with a 0.92 reading on the put call ratio. That's actually on the lower end of the range here. So I would say, you know, complacency, right, is kind of a little bit where it is in the territory of. It's not extremely complacent. It's not like a big alarm bell, but, you know, you tend to kind of get in recent times anyway, about 0.9 or so is usually when you get a little more of a spike in fear. So we'll keep an eye on that. But 0.92 going into the long weekend, a little bit on the light side. Now, sector performance this week definitely reinforced it depended on the stocks that you owned, whether or not you were happy this week. It was a very split market here. You can see there were some strong winners and strong losers. Healthcare, utilities, and energy, top of the list here, 3% on average here for these sectors. Very strong week for those three. On the downside, if you were in industrials, discretionary, or even some technology, you were feeling a bit more pain, down about 3%, down to 1.5% here. So they were the underperformers on this list, and definitely, again, a very split race here in terms of sector performance on the week. Now, this is the bright spot here. U.S. Treasury yields, they just continue to fall. We are now at 3.28 here on the 10-year. Not long ago, we were at a 4% interest rate here for 10-year yields, and, you know, that's a huge difference. Last week alone, we were at 3.5%, and now we're closer to 3.25%. So this continues to unwind here. Continue to see this rotation into bond markets. Now, last but not least here, if we're looking at some of the commodity plays, you can see crude oil up 5.75%, big week for it. Silver as well, 3.5%. Gold was up almost 2%, tapping on those all-time highs. Agriculture DBA here, ETF was up 1%. Dollar index was down. Bitcoin down. Copper down. Natural gas continuing to unwind here. So you can see kind of getting a continuation here. Continuation lower in natural gas. You are getting this rebound in crude. It is now back to positive territory over the past 1 month. And you're really getting this big push here in silver. So nice kind of spread here, but a very split market here depending on where you were in commodities this week. Dollar index, of course, was down. So it tends to support this trade. So we're going to keep it there for part one. We'll be back here in just a second with some charts. All right, here we go. We've got TC2000 up and loaded on our desktop here, and I'm going to start with a different view that we don't always look at. This is our custom support and resistance indicators. So these are custom indicators basically that programmatically sort of annotate, highlight, they identify prior support and resistance levels on any chart. And so for you TC2000 users out there, you can download this off our website. It is a paid download, premium product, but if you like the layout and you are looking for some objective ways to sort of identify those key levels, check out traders.com/store. You can find it there in our indicators. So the reason I wanted to start with this is because I loaded up so I got the Dow Jones in the top left, S&P 500 in the top right, Nasdaq 100 bottom left, Russell 2000 bottom right. And I thought it was just interesting here to look at the slope of kind of the last 3-4 months of price action across all these markets. So basically here, let's just start with the Dow Jones in the top left. You can see that you've kind of got this series of sideways to lower highs and sideways to lower lows that have kind of crept in here for the Dow Jones. Clearly, you're trying to make a run at breaking this pattern right now. So you can see price is just this solid white line. And you can see we're starting to kind of break through the cluster and series of lower highs here. So that is a positive here in the short term, but generally speaking, pretty trendless. If we look at the S&P 500 here, again, you got this similar pattern. You've just got lots of sideways. You've got, basically this chart starts here in the middle and it ends a little bit higher. And you can see we're fighting through and trying to break out of this cluster, this recent series of lower highs. Bottom left is the Nasdaq 100. Now, this is the best looking of all markets. So notice here that price, white line, is above all of these prior identified sort of resistance areas here. And you can see we basically start in the bottom left and we finish in the top right. So this just speaks very objectively and illustrates nicely the outperformance here out of technology in the Nasdaq 100 throughout 2023. And then you got the Russell in the bottom right, and this is the worst looking. It basically ends in the bottom right here. And so you've got price that was kind of all over the place, but really broke down hard in March and is trading at the lower end of this, basically of this chart. So I thought this was just, high level bird's eye view. This helps, cleans up the noise, gets rid of candlesticks, just shows, a white line chart on black graph paper, gets the point really across of where are we, what's the trend out here in markets. And so basically when you look at these four major US averages, you just see that indecision. You see clearly the Nasdaq outperformance, but then you look at everything else and it's just a little more muddied, it's a little more messy, and downright bearish here, I guess, if you were to look at the Russell over this time period. So I thought that was interesting. Let's look at specifically some of the levels that we've been talking about over these past handful of weeks. So basically here, if we look at the S&P 500, we've talked about the two big areas, the two big, inflection zones that we've been tracking, basically 4,000 in the S&P 500 and then 4,100 and then 4,180 or so, right? Generally, they do kind of cluster around these round numbers, but it's where the market has previously cared and shown where it, previously inflects. And so here you can see that we're fighting it out around this 4,100 zone. We got as high as basically 4,130. We finally saw a little 2-day pullback this week. And now here you go. You've got this stand into the end of the week on Thursday. You saw the market turn around and close at its highs, tried to take out, and in fact succeeded in taking out Wednesday's highs. And so we're left, let me clean this up. We're left at sort of an interesting, kind of turning point here going into next week. And I'm actually really excited about just this very tight range here. And I don't often like to get too narrow on the short-term levels, but I actually do think that these levels are fairly notable here. Essentially the lows from Thursday, the highs from Tuesday. I think this is a pretty good actionable kind of short-term range here because of where it's located, because we're at this 4,100 zone, because we're at, just where the market has failed multiple times over the past year. And we finally got a little bit of that volatility this week here. And I think we're set up for just a little bit of, maybe some clarity, if nothing else, right? If we break out and bust out through 4,130, again, same thing like we talked about with the Nasdaq 100 the other week. I mean, if we're holding over 312 here, if we're holding over these February highs, it's really hard to be bearish on this market because we're just holding up way too well technically. And I would submit that S&P 500, if it starts taking out these Tuesday highs here, it's kind of that similar situation where it seems like it's going to make a very quick attack on this 4,200, 4,180 zone. And, that's certainly where I think a lot of technicians are going to be paying attention to because it is coinciding with lots of tops. But I think, after you got this nice 2-day pullback, it's going to be just very interesting to see if buyers just reclaim their footing very quickly. And if they do just get a strong follow through day here to start next week, then, it looks like momentum just wants to carry us higher in the short term. Now, again, I have not been one that has, easily caught this move. I have been much more glass half empty, much more, sort of pessimistic on this market over the past handful of weeks. And again, I'm still kind of that way. I do like the little reset here. I think this gives, again, a technical perspective to maybe get on board this trend for maybe a squeeze back up to 4,200 if you're so inclined to play that. But basically, I have been very much kind of sidelined here and just watching and waiting and seeing how this market handles these different areas. And so I haven't very much participated in my own sort of discretionary trading. Luckily, that's why I have automated systems that do the trading for me. And that's why I love it. in terms of just being exposed, even if I don't personally see a tremendous amount of upside. So S&P 500, the way I look at this, 4,100 all the way up to 4,130. I'm looking at these levels just like this very closely. Next week, what does this market do? Does it start to trip and stumble and then, kind of drip lower, or can we push up here, find follow through and make a run on the February highs? That's what I'm going to be looking for. We're going to have earnings season very quickly coming up here in the next couple of weeks. So that's going to be interesting as we have catalysts, fresh catalysts on deck. Earnings estimates continue to get revised down. So I don't, quite frankly, I don't know if that's a good thing in the sense that the bar is just getting lower and lower, or if the market is going to face some reality here and that's not fully priced in. It'll be interesting to see in earnings season this next couple of weeks on how the market starts to take it. But technically here, I mean, a digestion week, right? Look at this week here, a little bit of just indecision, very tight range, a little bit of, basically just sideways action, and we got some compression. So I think that's actually a good thing. Let's go to the Russell 2000. This has been, clearly the underperformer here, has a lot of financial exposure here to those regional banks. You can see it's now back towards the lower end of its range. It's just kind of hanging out here, not a whole lot of momentum. It's consolidating and had a big drop in early March. It's just working that off here and still kind of TBD on its overall direction. I will say when you take a step back and zoom out from a weekly perspective, you do have just a very nice kind of sideways cluster, sideways range here, very much kind of reminding us now of what the Russell really did back here in 2021, when it just took all this time moving sideways in a very orderly range. Well, it's basically doing that again in just a new range, right? It has carved out this 170 to 195, 200 area, and it's TBD in the middle right now, and not really doing a whole lot of directional kind of trending behavior at this current time. So we'll see how that shakes out. And then if we look at the Nasdaq 100, again, this has been the clear performer here. We've talked about this quite a bit. 310, right? This has been the zone here, and I would still say if Nasdaq can stay over 310, life looks pretty good for the bulls. If we start to cascade below you could say 312 to 310, anywhere down in here, if we start, abruptly losing this zone here, I would become much more concerned much quicker. As of right now, we are looking like a semi kind of textbook bull flag here, checking back after a couple of days, just of shaking out the weak hands. And if we can just get strong follow through and we start to power through 321 to the upside, it's just very hard to be short this market. Technically, it looks like it wants higher, but like we say, underneath the hood, we look at breadth, we look at some other things. It's not as rosy as this picture, this QQQ actually, presents itself. And so let's actually go right to it, because one of the things I wanted to talk about today was the equal weight indices here. So let's look at the equal weight of the Nasdaq 100. Now, again, it is still up here. It's hanging out towards, the upper right of the last several months of essentially consolidation and range. But notice here that this hasn't quite broken out yet, right? We're actually still under some of this supply and some of these peaks in here for the Nasdaq 100 equal weighted index here. So this strips out some of the mega cap components of Apple, Microsoft, and Amazon that just drives everything, and it starts to treat everything as an equal. And you see that the breadth isn't quite as strong here on the equal weighted index. And you can look at this same scenario here if we just looked at the S&P 500. And so if we go to the equal weighted S&P 500, this is a lot different, right? Like this chart looks different. This arguably is a much bigger difference, and maybe because there's 500 stocks here versus the 100, but still, I mean, this is what the equal weighted S&P 500 looks like, and you can see we've just got bands of kind of the top end of the range, which has not been even tested. Right. So we are still well below a lot of these peaks and valleys, and still in a downtrend here. Objectively, we're making lower lows, lower highs here. So this is, again, something you can't trade this outright specifically. I mean, I guess you could put on some spread trade that could maybe harness this, but this is just showing you a kind of another illustration and some more color as to market breadth, where, you know, if you just take out the mega caps, you don't have things that are so concretely bullish, let's call it. So I'll leave it there. I'll let you draw your own conclusion as to how impactful that really is. We talked about, let's see, we talked about VIX. Did we just a smidge? We talked about VIX at the start. So you can see it is back down below 20. I do like that, right? I you know, back up here when VIX was really hanging out and looking pretty stubborn in the mid 20s, this was definitely a concern, but it has continued to now slide lower. It's back towards the lower end of this year's range. So it has been jumpy as it gets down into the 18s for VIX, for volatility in 2023. We'll see if this time is different, or if we are in fact going into a new sweet spot, trending bullish environment. This would coincide, just by the way, this would be your scenario here. I guess if you're very bullish on this market, or if you do believe in the bull case here, then what I would say is the bet you're kind of making, or the way I would see this playing out here, would be a break over 4,200, kind of confirming, I don't want to be too overstating here, but kind of confirming that this is a bottoming pattern, but over 4,200 probably coincides with VIX really finally breaking down into the, you know, mid-teens, let's call it, below 18, and settling into the 16, 17. So I think that's the bullish case there, is you get that breakout over 4,200, you get VIX back down into the 16, 17 range, and then you get potentially just a nice melt up, kind of uptrend phase, right? So not saying that is the case. I'm not even necessarily personally in that camp myself, but that's kind of the, you know, regime shift you would see from here if we don't bounce from 18, if we don't get some type of move and hold in this general area. So that's the S&P 500. That's the VIX. Let's move on to some commodities here. We'll go to USO. I mean, it's a beautiful move this week. I mean, it started with a gap up on Monday and just totally sideways, just really kind of lockstep holding in there, and very tight trading going on here. We're at, you know, a place where oil was trading for multiple months back in the fourth quarter, early 2023, and now we're just kind of hanging out here. You can see we've had a big move, vertical move, V-shaped move off of these first a steep decline to start March, and then just this big recovery, 20% off of the lows, and here we are back again right where we started the month of March. So we basically, you know, started the month and ended the month nearly the same, although there was a heck of a lot of volatility in between. So TBD on that. That's what the weekly chart looks like, and this is what the monthly chart looks like. I mean, you basically have this big hammer that carved out here, is big kind of tail that got printed here in March. And now wouldn't it be something if this just launched higher from here and took out this resistance? TBD on that. It's a little overbought in the short term, but that's what you're looking at. And then finally, if we look at 10-year Treasury bonds, so we talked about interest rates and yields all coming down. Well, here's your inverse. Here's the 10-year IEF bond fund, 7 to 10 year, and you can see it's just back up towards highs. Does look like it wants to move up here. You know, does it have a move all the way to get back up to the June highs here? That would put, you know, the 10-year back below 3% for sure. So this will be interesting. Obviously, lots kind of, you know, riding on this in terms of markets, pricing, technology, growth, discounted cash flows, all that stuff. It all ties back to dollar strength, yields, and what what those markets are doing and what those capital flows look like. So definitely pay attention to this, but right now certainly a good thing, and continues to move higher. And last but not least, let's just look at the dollar really quick. You can see still struggling to kind of stabilize here. It's putting in lots of tails over the last 3 weeks on the downside, looking like it wants the bottom, but still tough, still trying to. So we'll see if it can actually get some follow through, break this downtrend, and start to lift up. That would, generally speaking, be bad for equities. But TBD on that. So that's it for all of the market stuff. Let's look really quick at some industry results here. So this is again another custom layout of ours. You can find it on our website, but this is just identifying strong and weak sectors, industries across the week. So drug manufacturers, nice big move up there. Gold breaking out to new highs. Insurance brokers starting to challenge those recent highs. Publishing breaking out to new highs here. Silver specifically, basic materials starting to move back up towards highs. Utilities, very strong week for utilities across the board there in the different industries. And on the downside, again, very split market this week. Auto parts sinking to new multi-month lows. Electronics and computer distribution starting to break down a little bit. Engineering and construction, little maybe head and shoulders there. Farm and heavy machinery breakdown there this week. Home furnishing and fixtures, rental and leasing services starting to break down. Shipping and ports starting to get back to lows. Tools and accessories, new recent lows. Trucking, just kind of consolidating, but back to the lower end of its range. So that is what I have for this week. Went a little bit long, but hopefully it was helpful. Hopefully you guys and gals out there are enjoying the long weekend. Thanks as always for tuning in. I want to again welcome you in comments, your thoughts. What are you looking at this week? Earnings season coming up. You believe in this market? Leave us your thoughts below. And with that, I want to thank you again. We'll see you back here next Friday. Have a good weekend and talk soon.